Hello, it's me again, the guy in his loft who makes videos, who at this point could just be a floating head. Have you ever actually seen my legs? A video topic for another day, I feel. Chances are you discovered my channel through the video I made on investing for beginners. In that video I outline how to get started investing, and we talk specifically about life strategy funds, which I continue to be a fan of, and I'm not the only one. Take a look at the list of the top 10 most popular investment funds in April 2021 and you will see the Vanguard Life Strategy funds feature very heavily. But when you're on the throne, people love taking shots at the king, and YouTube is littered with creators criticising these life strategy funds. So in today's video, which will be episode 3 in our Vanguard series, we're going to explore these criticisms of the life strategy funds and see if we still think that they're worth it in 2021. Because in the words of Omar Little from The Wire, if you're coming at the king,
you best not miss.
The year is 2011. And the British investing landscape is dominated by star fund managers. Neil Woodford and Mark Slater lead the way with a focus on big British business.
Britain is open for business.
At this time, Vanguard was actually a little known brand in the UK, but they had something in the works that was about to change British investing forever: the life strategy funds. Fast forward 10 years, Mark Slater is still doing all right.
Great pleasure.
But Neil Woodford lost billions in investor money, fled to Dorset and ditched his wife for his secretary. Some might say he's also doing all right.
To some extent, yes.
But the real star of the show in the last decade is those life strategy funds, becoming the dominant force in UK investing, convincing millions of Britons to look at passive, world-focused investment strategies over actively managed UK-focused ones. Just like Neil's reputation over the last 10 years, the sentiment towards big British businesses has gone down the toilet.
That the UK has been deeply unpopular now.
And here lies the first criticism of these life strategy funds. Since their inception in the last 10 years, US tech has dominated. Apple is now bigger than the top 100 companies in the UK combined. That's a testament to Apple's success, but also a nod to how badly UK companies have performed over that decade. There's a whole host of factors on why the UK has fallen out of favour, including the illness and Brexit.
What is the economic impact?
And most importantly, the low interest rate environment we have found ourselves in as a result of the financial crisis.
As we go on air, there are crisis talks about how to stabilise the banking system.
The UK's version of the American tech industry is our finance sector, and typically banks make money by lending people cash. The lower the interest rate, the lower the profits on those loans that those banks make. When Vanguard launched the life strategy funds here in the UK, they were acutely aware of the success of fund managers like Woodford and the popularity of UK businesses here. At the time, the average UK fund contained about 60% British businesses, showing that us Brits loved a bit of British.
Very proud to be British.
So Vanguard needed to accommodate for this. So depending on which life strategy fund you opt for, the allocation to the UK can be as high as 20 to 25% on the stocks and shares, and 30 to 35% on the bonds. At the time, this was seen as a modest contribution to the UK markets and was done solely for the purpose of making UK investors feel comfortable. But when you consider the UK stock market is only about 4% of the global stock market, that is a very heavy weighting towards the UK, and if the UK underperforms like a lot of people would argue that it has over the last decade, it will drag down the performance of the fund. But it's so easy to look back at the last 10 years when we know what the performance of a country has been and to slam them on that basis. It's not as easy to look forward and predict what the UK markets will do. As we all know, past performance is no guarantee of future returns. To play devil's advocate, I could point out that tech stock valuations in certain areas look crazy at the minute. And if the doom and gloom about inflation and thus interest rates rising does come true, then the UK finance sector may actually benefit from this.
The money is ridiculous.
I could also point out the fact that typically when people say don't invest in something, it's probably time that you take a look at it.
You have to be fearful when others are greedy, and greedy when others are fearful.
Or as Bruce Willis put it in The Lucky Number 11,
it's a Kansas City shuffle.
This overall pessimism towards the UK market could be the very opportunity that we're looking for when considering to buy something.
It's unpopular and it's dislocated. So I think that makes it an interesting space.
One consideration to make is if you opt for a fairly balanced fund like the VWRL World Fund, fairly balanced means that 60% of your funds are going into the American market. And the American market is dominated by a handful of huge companies. What if over the next 10 years, they don't do as great as they did in the last 10 years? Look at Apple's share price in the 90s. It did nothing. Just because tech has smashed it in the last 10 years is no guarantee that it will continue to do so in the next 10 years. And to write off the UK market on past performance, I think could be a little bit short-sighted.
You've got a very unpopular market, which is cheap by any standard internationally. Very cheap, one of the cheapest, I would say.
I personally do think, though, that tech is here to stay. But at the same time, I wouldn't write off the UK just because it's had a bad decade. We have a track record for punching well above our weight on the global scene. And with the life strategy funds, you're still getting a massive amount of diversification exposure to all markets. With the 100% equity, you're still getting 31% of your money going to America, by far the biggest proportion of the fund. The next criticism I hear about the life strategy funds a lot is in relation to bonds. Even I've been critical of bonds, mainly around the idea of lifestyling, which is where effectively, as you approach retirement, you increase the allocation of bonds that you have in your portfolio and reduce the amount of shares. My main argument here was that retirement now lasts a lot longer, and I believe individuals should continue to invest in equities into retirement and not continually increase the amount of bonds versus stocks they have as they approach the end of the working road. With the life strategy funds, there is a selection of funds based on different percentages with a mix of bonds and equities or shares. So the 100% life strategy fund is 100% stocks, and the 20% life strategy fund is 20% stocks and 80% bonds. So you're not watering down your allocation to stocks over time, you're picking your allocation and you're sticking with it as long as you invest in the fund. Chris Bourne, whose channel I will link in the end cards,
I'm Chris Bourne.
did a great bit of analysis on how Vanguard's approach to bonds in the life strategy funds is different to that of other fund managers. Chris essentially argues that Vanguard use bonds not to improve the return of the funds, but to instead act as a risk dampener. Essentially, they use high quality bonds such as AAA rated government bonds because they are known for not being correlated to stocks. So when stocks move one way, the bonds move the other.
It's a Kansas City shuffle.
I think the most important thing when it comes to investing is picking an investment that will allow you to stay in the market. What I mean by this is if the markets swing around and you're going to lose sleep over that, then the 100% equity allocation might not be for you. The crypto collapse the other day is a perfect example of what I mean. As the price of cryptocurrency collapsed, retail investors sold out because essentially they just couldn't handle the volatility. It's funny really how people want 10x returns but won't take 10x downside. Data showed it was retail investors, people like you and me, who sold off, not the institutional money like banks. If you think a downturn in the stock market is going to send you clean under, you can essentially taper off the volatility with the higher allocation of these high quality bonds. There's absolutely nothing wrong with being honest with yourself and saying, look, I can't handle mad swings in the market, and then stepping down your allocation towards stocks and shares to allow you to remain invested. I would rather see someone invested in the life strategy 20% than not be invested at all. I also think that the life strategy funds with high allocations to bonds present a unique opportunity to investors who want to invest short term. Something that goes against common logic with investing and even the message that I preach on this channel. But hear me out. The 20% equity life strategy fund has returned on average around 5% per year in the last 5 years, vastly underperforming the life strategy 100. But you will also notice the 20% has never dipped into the red over that time period. If you're saving for a home and you're looking for a place to try and achieve a rate of return higher than inflation, these high allocation bond funds could present a suitable investment for people with a shorter time horizon. Obviously, I'm not a financial advisor and you shouldn't listen to a word I say, and past performance is no guarantee of future performance, but the allocation of bonds within these life strategy funds and the ability to dial that up and down dependent on your own risk tolerance and timeframes for investing means that I think they have a place in the market, and I think they're actually quite interesting for that reason. The final criticism I hear a lot is in regards to the fees. All of the life strategy funds have a fee of 0.22%. If you add the Vanguard platform fee on of 0.15%, then you get a total fee of about 0.37%. The argument with fees makes me laugh really, because I live an incredibly dull life. Vanguard is famed for coming to the UK market and forcing everyone to drop their fees. It now seems that we've become so accustomed to low fees that what was once cheap is now deemed expensive. Let's face it, these fees are still cheap, and these investments are aimed at individuals that can just pick them up off the shelf, one purchase, and not need to worry about anything ever again. There's got to be some form of fee for the element of convenience they provide. How many people that are criticising these fees order a Deliveroo every week? Yes, you can pick a selection of your own funds and then you can rebalance them yourself each year if you like, selling off the ones that have grown outside of your selected allocation preferences and rebalancing the portfolio. But there's a whole load of people watching this video now who probably just don't want to do that, and they're willing to pay slightly extra for that convenience, so that they know that they can pick something up off the shelf, invest in it every month, and it should theoretically do everything that they need it to. There is a saying in filmmaking that goes, the best camera is the one you have with you. And what that means is, in a position where there is a great picture or shot to be taken, the camera you have on you, the camera that allows you to get the shot, be it an iPhone, Kodak, whatever, that is the best camera that you have. It does not matter if you have a super expensive Sony at home on the shelf, it is useless to you at that moment you want to take that picture. With investing, it's my opinion that the best investment is the one that helps you stay the course, the one that helps you invest long-term consistently, and the ease of use with the life strategy funds to many people is exactly that. There is a proportion of investors out there that will actively manage their investments and sweat about every percentage point they can get. And in the long run, they will likely do better for it. but there's just as many people out there who find the idea of investing intimidating and confusing. And to be put off by the intricacies of rebalancing and picking your own funds would be a crying shame, because in my opinion, the biggest risk that modern investors face is not investing at all.
I'll see you next time. Ta-ra!